Hey guys, we tried a live Facebook feed earlier today and the sound quality was pretty average, so we're going to take two. Okay, so recently I've been getting some commentary on social media about the fact that I've been talking about making sure that you get invested in financial markets right now. And some people have been saying now isn't the right time to get invested in financial markets. Others are investing in the financial markets. I want to share with you a little bit about how the financial markets have played out over the last 100 years and what is likely going to play out over the course of the next 3, 5, and 10 years, given history and what's happening right now with central banks and governments and interest rates, etc. So when we look back over the last 100 odd years, all the way back to the Great Depression in the late 20s, early 30s, we see that there's really been 6 significant stock market corrections. We had a low in, I'm going to read some years here, 1933, we had a major low in 1970, we had a major correction and a low in 1975, 88, the stock market crash, of course many of you remember, 2003, which was the dot-com bubble, and the GFC, which was in 2008, and of course the major COVID-19 crash that we saw on March the 23rd, 2020. Now, when we look back at history and we look at all of those time periods, let me share with you how long it's taken from the low in financial markets to trade back to the high, and let me share with you why over the course of the next 3, 5, 10 years, getting into and understanding how to invest now can potentially pay huge dividends over the years ahead. But if you make your window of expectation too short, you're likely to sell at the wrong time, buy at the wrong time, buy the wrong stocks, and actually end up losing money rather than benefiting and making a significant return over time. Now, between 1933, where the low was in the Great Depression, it took 13 years for the market to trade back to the high. But you've got to understand, it only took 2 or 3 years for it to recover 50%, and then we had World War II. So there's a significant event that happened during that 13 years that played against the stock market rising back higher. But it did take 13 years. In 1970, it took 1 year for the market to recover back to the highs. Now, all but one of these corrections, the market corrected 50%. The stock market in 2020 has only corrected 34% on the S&P 500. It hasn't actually corrected 50% yet. In 1970, it took 1 year to recover. In 1975, it took 5 years to 1980 for the market to recover. Then in 1988, when we had the stock market correction, then we had 1 year for it to recover. Just the 1 year. In 2003, the dot-com bubble, it took 5 years for the market to recover back to the highs, and that's where we got to in the global financial crisis, or just prior to the global financial crisis, melting the markets down again. It took 5 years, 2003 to 2008. When we had that global financial crisis, it just took 4 years for the market to correct from 2008 back to the highs, rally back to the highs in 2013. So what I'm sharing with you now is that the importance of understanding when we see these significant pullbacks. Number one, we could go lower. We could go lower. History says when we see these sorts of recessions and economic pullbacks that we're seeing, the market generally pulls back 34 to 50%. So the probability is we could go lower. How do we invest through this period to profit on the other side? Well, I'm going to share that with you in a moment. But what we saw between 2008 and 2013, and what we're seeing again right now, is central banks and government inject massive amounts of money into financial assets and economies. Interest rates, guys, are going to remain low for the next 3, 5, and potentially for the next 10 years, as they have remained low since the global financial crisis. What does history show this is going to be good for? It's going to be good news for the stock market. Yes, things could get worse before they get better. And in my view, you should not be considering investing all of your money into the financial markets right now. What we're doing here at Trading Mastery is drip feeding our money into the market as the year goes on. Drip feeding our money into great quality companies that are doing well pre-COVID-19. that have very strong balance sheets that will likely thrive post-COVID-19. And we're setting ourselves up with an expectation and of a window of opportunity over the next 3, 5 to 10 years. Anyone looking right now in the next 6 to 12 months in the stock market is playing, in my view, a dangerous game. But if you're willing to start to invest in the right companies now, and here at Trading Mastery, we had 3 portfolios here in Australia, in the United States and Europe that we're investing in great quality companies that gives us diversification in very cashed up businesses that are highly likely going to thrive post this crisis. They're going to return our investors potentially well above average returns on investment. But if you invest all of your money right now, as so many people will do, is they'll see the stock market crash, they'll open a trading account, open an investment account, put their money into stocks and companies that just look like they're cheap. They're sexy brands. But do you know what the balance sheet is? Do you know what they are, what debt they have? Are they likely going to have any cash flow in the next 6 to 12 months? What's the support are they getting from a fiscal and monetary policies perspective? Are they going to thrive post this crisis in the next 3, 5, 10 years? Well, I believe I do understand what those companies are going to be, and that's where we're putting our money. And what I encourage you to do is to get invested right now. But make sure that you have the right education and the right advice to be able to help you understand how to not leave yourself exposed with a lot of leverage, too much money in one stock, too much money in one sector, and be able to have a time horizon that is realistic, that's going to allow you to prosper and make above average returns in the future. So is right now the right time to be investing? Absolutely it is. But provided it is in the right companies with the right amount of money that you can continue to drip feed some money into over the course of the next 6, 12, 18 months with the expectation we could go lower. The market potentially could correct 50% or more. And what would the portfolio look like? How would we continue to invest? There has got to be a plan for that. But for those with that 3, 5, 10-year horizon, then the opportunity right now, guys, I'm not sure if we'll see this again for the next 10 to 20 years. And therefore, I don't believe anybody should be sitting on the sidelines as so many did back in 2008 and just watch it all unfold in the next 10 years. Because I can tell you, with interest rates remaining low and asset prices rising again in the next 3, 5 or 10 years, the rich will get rich and the poor will get poorer. You need to have some assets. And what will be supported is the stock market with monetary policy and fiscal policy to continue to support assets as it happened after the global financial crisis. If we can help you here at Trading Mastery, we'd love to do so. There's some great tools, there's a free mini course and a lot of great content over on tradingmastery.com.au. I wish you every success. If you have a question for me, you would like to ask me, please put it in the comment section below. Have a great Sunday, guys. Bye for now.